Hello, I'm Tony Kay. I'm the editor of Eureka Report, and I'm joined by John Addis, Editor-in-Chief of InvestSMART. Hi, John. Thanks for coming in.
Hi, Tony.
Now, today we're going to have a bit of a chat about the property market.
Yes, dangerous territory.
In particular, about what's really the whole issue around getting your children into the property market, or how do they get into the property market?
Or whether they should.
Or whether they should.
And I think that's probably the first question that, as a parent who's potentially going to be a bank to your children, that's probably the first question that they should ask. And this is my own personal view. It might not be the view of a financial advisor or anybody else, but having watched this stuff over the years, I think the first question is whether the child is spending less than they earn. And if they're not doing that, then the conversation isn't probably worth having.
I mean, in some countries, the whole concept of property ownership isn't really part of everyday discussion.
No, not at all. It's definitely the Anglo countries that seem to have an obsession with owning your own home. And there's no doubt that Australia's a big part of that. You know, on many measures, we have the most expensive property in the world. And I tend to think about these things in the way that I might valuing a stock. So if you think about the property market in that sense, and we'll take Melbourne as an example, we were chatting earlier and you were saying that I was saying, well, maybe the average yield on a property investment in Melbourne might be 3.5%. And you said it's probably a bit less than that. So let's call it 3%. And then you take off a percentage point for, you know, land tax and maintenance and paying the rental agency fees. So you're left with a yield of 2%. Now in stock terms, that yield that's a PER of 50. And I probably wouldn't be, I don't think I've ever bought a stock at a PER of 50. And yet that's what often most property investments and housing is trading on in this city. So that would be the second question for me. Do you want your children investing in or buying a house at this stage of the market?
There's a lot of discussion, as you know, just that the market at this particular point in time, it's overheated, particularly in Sydney and Melbourne.
Yeah.
Not so much in other parts of the country.
Yeah, that's right.
You know, whether now is the time or perhaps...
I think if you decide it's not the time, and personally there's very rarely a time to invest in Australian property in the past 15 years. I've been wrong about it for a long, long time, and viewers should bear that in mind. But once you decide you don't want to invest right now, the question for your children with that cash that they're generating, the difference between what they earn and what they're spending, is what to do with it. And for me, I think this is when the investment question feeds back into the conversation. And instead of saving for a deposit, I would be having a conversation around getting started in investing.
I guess if someone chooses not to go down the property investment route, I mean that's the key. And then you know, in terms of what do they do in the meantime? You know, do they rent and just basically sit things out, or do they continue renting? It's there's all sorts of different variations.
Look, as long as you're generating that cash, that's a very personal question. You know, because obviously we as investors like to take control of our own money. For most people, that's probably not the right response, especially if you're young. But my advice to my children, they're probably a bit young for this, but maybe in five years' time they won't be, will be to, if you're committed to investing for a decent period, and I think if you were trying to save a house now and you're in your 20s, you're probably looking at a 10-year period to get a deposit together anyway. Instead of leaving that money in the bank, I'd probably be looking at buying a very low-cost managed fund. I'd be correcting for the overexposure to banks and resources in our economy, and I'd probably invest regularly in it and leave it alone. And then in 10 years' time, I'm probably going to have more money than if I left in a bank. The time period is going to be long enough for me to minimise the risk of a blow-up around the time I want to take that money out and put it into a deposit in a house. And maybe, just maybe, in 10 years' time, house prices will be more reasonably priced.
Yeah. We don't know. But I mean, that's absolutely correct. You know, leaving your money in a bank, especially at the moment, you're going to be earning very low rates of return.
That's right.
And after inflation, you're lucky to break even after your costs. going into a managed fund product, at least you're in with a much better chance of getting higher returns over time.
And it's all about that time period. As long as if you're doing it for 1 or 2 years, then I wouldn't recommend it because you increase the chances of something, an adverse market event, undermining the money you're putting in. But the longer you hold it, the lower that risk is, and it's the same for retirees too. You have to look at that time frame. But with prices where they are now, I think that young people are going to be saving for a very, very long time in order to get a deposit together if prices stay where they are. And that means that you can invest in a managed fund over that time period and expect probably a bigger sum at the end of it than what you would have investing in a bank.
John, thanks for coming into the studio again. There's lots to discuss on this issue.
Thanks very much, Tony. It's been a pleasure.
And we'll see you again next time.
Love to.